Hello and welcome again to another financial analysis video with myself, Moeed Amin, and Ted Wayman. So the goal of this show is to help you improve your business acumen by helping you better read financial statements. If you understand the finances of a company, you actually understand the character of the business. And precious few people compared with all the professionals out there are able to read financial statements very well. As Warren Buffett said, if you want to understand business, then you've got to understand the language, and that language is finance. So we help you do that by analyzing famous companies. And 98% of those companies are actually made from requests from you, the viewers. And I'll talk about that later on or in a moment, how you can make your request as well. So let's dive in. Today, we're going to be looking at Serco. Now, Serco is a well-known UK business. They're essentially an outsourcing company, and they outsource services to the public sector. So think about defense, justice and immigration, where they'll outsource security agents and security tagging equipment, etc. In the health sector, the transport sector, as well as what's called citizen services as well. So they're a well-known outsourcing company in that respect. Their CEO, who's actually announced that he's retiring, but interestingly for those both in the UK and any of those abroad who are watching this, is a gentleman called Rupert Soames. Now, Rupert Soames is actually his name may not be that well known, but his grandfather is, and his grandfather was Winston Churchill. Now, he's retiring soon, but I thought that was interesting to share with everyone. A lot of you will have heard about the situation in the UK recently, where our Prime Minister and Chancellor put out a statement, a mini budget, which kind of sent markets really nervous and caused some problems in the gilts of what the Americans call treasury markets. And Serco was not immune to this situation. In fact, they have a pension scheme that's worth £1 billion. And that was put at risk. And that pension scheme had to then request a loan from the Serco business to the tune of £60 million. So they're not they were certainly not immune to this. I think a lot of pension schemes in this country have been affected by what's been going on. Now, you might want to look at that in more detail yourself. We're not going to be analyzing any of that background detail. We're just interested in the financial statements here. Now, this company was a request from two of our viewers, actually, and one of whom had requested two companies, James Fisher as well as Serco. James Fisher, we've actually already completed the analysis and published that video. So if you're interested in looking at that, just type in James Fisher financial analysis, or type in James Fisher within our playlist, and you will find that there. So thank you, Paul and Philippus, for your request. Here is your video. And you can also make a request. If there's a company that you're interested in, whether you are selling to that company, or whether you're thinking about investing in them, or if you're about to go for an interview and want to sound really smart and actually get that job, then leave a note in the comments section. Tell us the name of the company you're interested in and give us some context. The more interesting the context, the higher up the priority list you will go. So quick note on the share price, and stick around because we're going to talk about the share price as in context to the financial analysis that we're going to be conducting. The company IPO'd in 1988. If you invested back then, you'd be sitting on a profit of about 567%. I looked at this a couple of days ago, so you might see a different number here on our analysis, which is more recent. So it's about 567% increase. If you invested 5 years ago, you'd be sitting on a decrease of 35%. If you invested a year ago, an increase of 35%. And if you invested a year ago, it'd be an increase of 22%. So definitely some fluctuations going on there, and we'll dig into that further on. So without further ado, Ted, let's share with our viewers what we have analyzed about this company and help them make their own analysis in the future.
Good to see you, Moeed. Welcome back to all our subscribers. Welcome to anybody who is new to the channel. And if you are new, please do subscribe. Hit the button down below, wherever it is, and subscribe. Don't forget to like and share this video. Maybe send it to your colleagues. If you know anybody in Serco, maybe send it to them. And do please interact with us. So leave your comments. If you like what you see, leave a comment. If you're not sure, you don't like what you see, leave a comment. If we've got anything wrong, leave a comment. Obviously, if you are leaving comments, though, be polite. It doesn't cost anything to be polite. So here are the annual report and accounts of Serco. We're looking at 2021. Now, there are some half-year accounts out as well. We're going to be focusing on the annual report and accounts as well. If you can read the information here, then you can read the information in the half-year 2022 as well. Lots of information in these accounts, lots of the detail about what they really do, and what they're up to. There's our chairman. There is Rupert Soames there, as Moeed was mentioning. Winston Churchill, interestingly, our 60th and 62nd Prime Minister. There's a little bit of trivial information for you. Anyway, lots of information about who the company is and kind of all the pies that they've got their fingers into. But we are going to gloss over that and whiz all the way down to the income statement. So through the compliance activities, through the remuneration report, we'll get to the auditor's report, and then we get into the actual financial statement. So 195 of 268 pages, so quite a long way down. So here we go. Top line revenue, so the revenue or the sales of the company, there it is. So the revenue of this business, they are turning over, we're in pounds millions, so 4,000 million is 4.4 billion pounds. So there we go, 4.4 billion pounds is their sales. And that'll be the kind of, what they are charging the government. And then the cost of sales is the cost of the service that they are providing, 3.9 billion. Leaving them with a 468 gross profit. Now that's relatively low. So that gross profit margin is about 11%, which basically says for every pound they bill the UK government, it's costing them 89p to actually provide that service. So this is not high margin a game, and that kind of makes me feel reasonably comfortable as a taxpayer, because if they were making excessively large profits, I would not be overly happy, especially in the current financial climate. So gross profit for 468 million pounds, about 11%. They've then got the costs of running the business, which is 243 million pounds. So that'll be all their overheads, kind of rent, rate, light, heat, HR team, finance team, sales, marketing, facilities, IT, board of directors, remuneration, all that kind of stuff. And there's a few other bits and pieces in terms of the overheads. Anyway, operating profit, 216 million pounds. There it is. There's the operating profit, 260 million pounds, about 5%. So they're only getting to keep 5p after for every pound that they bill the government. You'll notice if finance costs are actually pretty small. So this suggests to me that they've got very little debt sitting on the balance sheet, and what debt they do have, they can afford, leaving them with a profit before tax of 192. Interestingly enough, also they get a tax refund in this year, so don't expect to see that on a regular basis. So we're going to see this profit figure is probably a little bit high. I don't know why they get a tax credit. They got a tax charge in the previous year. That 303 million sounds like a bit of a one-off, and in a normal state of affairs, they'd be paying, a tax at about corporation tax of, well, it was 19%. It's now gone up to about 26%. So you'd be sort of, ending up with tax, profit after tax of about 80 million in a kind of normalized world. Okay, so just to highlight that the profit figure looks quite high for this period. So nothing really to sort of exceptional going on in the income statement. It's obviously it's a low margin business. It's a low quite a low profitability business. If we go and have a look at the balance sheet, interesting enough, they give the statement of moved and equity before the balance sheet, but I don't think we should read too much into that. So the balance sheet, looking at the assets first of all, 2.7 billion of assets, 1.8 billion of non-current assets, so these are the things that we need to run the business, and you'll see that really, you know, that's the kind of, these are the big numbers here. So property, plant and equipment, relatively small. Right of use asset is effectively property, plant and equipment, which is leased. Okay, so that kind of photocopier, which is on a hire purchase in the corner, that's going to be in what we call the right of use assets. That's a kind of new statement bringing these assets onto the balance sheet. So they've got a reasonable number of right of use assets. This will be all their kind of, you know, furniture, for example, and laptops. Quite a lot of goodwill here, goodwill increasing. And this suggests that these guys have been growing through acquisition. So goodwill arises on acquisition of another business. It's not something you can, you can't take that asset itself, put it on eBay and sell it. So it's very much a kind of a nominal valuation. It arises on the difference between what you pay for a company and the fair value of the net assets. I don't think you necessarily need to know about that, but it just shows me that, you know, these guys, you know, they are a conglomeration of organizations, and quite often, you know, in order to gain contracts, they'll buy the company that has the contract and then kind of amalgamate them into the kind of the whole Serco offering. In terms of the current assets, so quite interesting down here, we've got a very little inventory because they're selling a service rather than stuff, so to speak. But they do have these contract assets, and I'm not sure exactly what the contract assets are. But what's interesting is that there's a kind of on the other side we see contract liabilities. So contract assets may well be some form of you know, honestly, I don't know exactly what they're kind of, you know, they're looking at in terms of those contract assets, and maybe you know, the note 21 would tell us a little bit more, but you know, that's telling us that they have these, you know, these contracts with the government, and that part of that contract can be recognized as an asset, but then there is a liability sitting alongside that. Trade and other receivables, relatively straightforward. And trade and other payables on the current liability side. What is quite interesting about these guys is that if you look at this business here, if you compare the current assets with the current liabilities, that's a traditional warning sign. Now, that wasn't a warning sign in the previous year. So the traditional kind of lineup is to sort of look at current assets, that's things that we own that we are trying to turn into cash or already are cash, and our current liabilities, amounts we owe and have to pay soon. And we notice that the ratio is below 1. So that's a little bit of an alarm bell that says, you know, there's a, you know, maybe there's a few issues. They've got a reasonable amount of cash, but liquidity is a potential concern. Let's put it like that. So interesting enough, if you look at that working capital and you run your working capital requirement, you know, it's you know, we kind of need to look at the we need to look at the cash flow to make sure that they are generating cash and make sure they can afford that low liquidity ratio. But that's a little bit of a concern to me. On the current liabilities, non-current liabilities, we've got some loans. There they are. So not a huge amount of loans. So their loan is relatively small compared with the total size of the balance sheet. So they've got about 377 million in loans, and the total equity in the business, there we go, to scroll down a little bit, there's the total equity, which is the shareholders' funds. Lease obligations, those will be the lease obligations alongside the right of use assets. So there's a kind of matching process that we can match those with the assets that we were looking at earlier. The loans are funding the business, and we've got, you know, this trade and other payables, reasonable size. Government not very good at paying, so may indicate a few cash flow challenges there. Company's been profitable, it's got retained earnings, and it has also been paying out dividends, as we will see in a minute. So we look at the movement in equity. Here's the movement in equity. We're looking at the retained earnings section here. They made a profit in the previous year, and then in this year they also made a profit, and you'll notice they paid out dividends in 2021, didn't pay dividends in 2020, probably with the pandemic, looking to kind of hold on to cash due to the uncertainty that year actually brought. In terms of the cash flow, so the cash flow, just for note for the cash flow, that they're generating a positive cash flow, and this is a pretty good cash flow, 350 million. So that's the sort of the cash equivalent of their operating profit, so to speak. So the or you know, effectively their EBITDA, so to speak. So operating cash flow 350, EBITDA is about 372. So they are generating, you know, they are profitable, they are generating cash. We need to look at note 36 to find out the reconciliation. So those of you who are familiar with these videos, you know, usually we get the reconciliation from the profit and loss account through to the cash flow in the top of the cash flow statement, but these guys have put it in note 36. So if we just whiz down quickly to note 36, here it is, and we can find that kind of that reconciliation. So here's the reconciliation. Profit before tax is 192. There's the operating profit of 216. The cash profit is, we'll just scroll down. In fact, let's just zoom out a little bit so we can actually see that. Hold on a sec. So we can see all the numbers on one page. There we go. So what we've got is our operating profit, and there is the net cash flow. And what we can see here is sort of non-cash items, so things like depreciation, for example, being added back as the non-cash items. And then there's this little bit of movement in working capital. Now, there's not a huge amount of movement in working capital, and that's good. Okay, so they're not seeing a massive increase in payables, for example. They're not seeing a massive increase in receivables, which is causing distortions in their cash flow. So cash flow looks pretty reasonable. Return to our cash flow statement here. So pretty strong cash flows coming through, easily enough cash flows to pay for their investing activities. So here you'll notice, you remember goodwill increased. Well, that's why goodwill increased. So they made a purchase of a subsidiary. So these guys, they don't really need to spend a lot on property, plant and equipment. You can see the purchase of property, plant and equipment. In fact, we can't even see the property, plant and equipment in there. So yeah, so purchase of property, plant and equipment is not a huge amount, because you know, they're providing a service to the government. They don't need lots of stuff, so they don't need a huge amount of investment. You'll notice the previous year they actually generated cash from their from selling stuff that they didn't need anymore. So they're selling a bit of property, plant and equipment and buying a little bit of property, plant and equipment. So these guys are not, you know, the significant investment there is the purchase of another company, and you can find out which company that is by looking at note 7, for example. And so then from the financing of the business, what we see here, the financing, negative 250. So what are the big numbers there? They're repaying loans, so they're trying to reduce their loans. They've got some loans coming in, but on a net basis, there's a little bit of refinancing going on, but on a net basis, they are reducing their loans, and they're paying leases as well. So those lease payments on those right of use assets is probably their biggest cost. And then the dividends we mentioned earlier, and they've also done a bit of a share buyback as well. So for 40.7 million of own shares repurchased. That's a kind of, you know, a share buyback going on there. So there is the kind of the performance of the company. It's looking pretty reasonable, I have to admit. I mean, it's you know, there's no sort of real warning signs apart from that liquidity ratio, which, you know, just looks like, you know, as soon as it dips below 1, it just makes me a little bit nervous. So, but I think the kind of the big challenge for these guys, and we'll kind of see that in the share price here. So if we look at the share price, it's kind of, you know, it's off the boil a little bit. I think the real challenge that they're going to have, you know, they've been basically going sideways for the last, you know, X number of years. The real challenge that they're going to have is that, you know, these guys are contracted to the government to provide the service, and the government expenditure is under massive pressure at the moment. So these guys, you know, there's going to be a big kickback in trying to reduce the amount of money that they are paying and eliminating services which really aren't necessary. So these guys, you know, there's going to be a constant, I mean, I think, you know, working with the government, there's always a constant sort of challenge of being able to, you know, sort of, you know, up your sales. But, you know, certainly for these guys, I think that's going to be, you know, the challenge that they face going forward. So if we look at the P ratio now, if you take the market cap, which is about just shy of £2 billion. If you compare that to the earnings for this year that we were just looking at, 2001, you're looking at about 6 times earnings. But don't forget, the earnings for 2001 were kind of distorted by that big tax credit that was credited back to them. So I think a P ratio of 12.53 is much more reasonable. So that's about a 6% yield, probably a 7%, maybe even 8% yield, which is reasonably good. Dividend yield is 2%. Don't forget they've got share buybacks as well, though. So I would probably include that as well. So, you know, it's not cheap, it's not expensive, it's kind of what it is. So you know, I'm not necessarily saying this is a screaming buy. I'm not sure it's a screaming sell. I think it's, you know, if you've got it in your portfolio, it's probably a screaming hold, and it sounds, you know, pretty boring company, pretty boring share price. And that's probably what we want from somebody like Serco. We want somebody who's just, you know, reliable, solid, and is going to provide the service that they're contracted for on an ongoing basis. And there you go, Mo. That's kind of my take on it. I'm not sure I'm really able to kind of add a huge amount to the kind of the analysis, but hopefully a few people have found that useful.
That seemed useful to me. And like I said before, purpose of these videos is to show people how to read and analyze and draw conclusions from financial statements, or certainly when they read something in financial statements, are there any further questions that we need to find answers to? And we've done that there. So hopefully that's helped you. So when you look at any future statements, whether it's Serco, another company industry, or any other company, you're able to read those financial statements more quickly and more confidently. So thank you for that. If any of you have any other companies you would like us to analyze, again, do leave a note in the comment section. And as always, like, share, subscribe. We'll see you on the next video. Thank you, Ted. Thank you, everyone else.
Good to see you, Mo. Catch you later.